Hey everybody, and welcome back. This is Maria with Simplified Strategy and Bookkeeping. I'm so happy that you are here to join us for part 2 of our Love the IRS series. So never thought you'd probably hear that term out there, but anyway, this is a video series. It's a 4-part series where we're talking about just really learning what the IRS tells us about our business expenses and our business deductions and how these things actually work. So in part 1, just in review, we talked about the cost of goods sold and really what is the cost of goods sold and how that is a particular type of business expense. And so today we're going to talk about a different kind of business expense, and it's called a capital expense. And there's different ways that you handle these types of expenses. So some of you watching this video might have just started a small business, or you've been in your small business for some time. And maybe you work at home, maybe you have a few assets that you would say that you have in your business. So what is an asset anyway? Well, an asset is something that your business owns. And so for myself, in my bookkeeping business, I own a few assets. I have a laptop, I have a desk that I'm sitting here with, I have a space in my home that I'm using for my business. And so I have very few actual assets that my business owns. Now, not all businesses are like that, right? You see businesses every day. You might see trucks driving around doing HVAC repair, or you might see a doctor's office or a dentist office. And so depending on the type of business that you have, you might have a little or you might have a lot of these assets, okay? So going back to my example is I have a laptop computer. And it was not just a cheap purchase. It was something that I purchased for my business. Now, it also could be a business asset if, let's say, you as the owner had something that was your personal asset, but you basically gave the asset to the business. It still counts as your business asset. So anyway, in the example of this laptop computer, there's a couple things that I might want to think about other than just making it an ordinary business expense. Is I have to think about two things. I have to first of all know how much I paid for the laptop computer, and then I also need to think about what is the useful life of this computer? How many years do I think I'm going to use this computer for the business before it needs to be replaced? And so if I have that information, then what I can do is I can count this expense as a capital expense. So it's not quite the same as, for example, I'll use another of my business examples, is I have I use an app called Asana for all of my task and project management. And so I pay a small fee each month for the use of Asana. And so that is an ordinary business expense. However, my laptop was a lot more than the Asana subscription is. And so what I want to do is I want to call this laptop a capital expense. And then what I'm going to do is basically take those two variables of how much money it costs me to buy and then the useful life of the item, and I'm going to do something called depreciation. So I'm basically going to say that if I paid, let's say, $1,000 for the laptop, and I believe it has 3 years of useful life, then I'm going to depreciate that asset over that 3-year period. And the goal with all of this, by the way, is that I want to say that the money I spent on the laptop was worth the income and sales that came from the laptop. And in my example of a bookkeeping business, this is how I run my business. Without the laptop, I would not be making an income because everything I do is through my laptop and it's online. And so let's take another example. Let's talk about those trucks that you might see driving around doing HVAC repair. Same principle applies. So in a case of that HVAC company, just like I have an asset of a laptop, they have more assets. They have these trucks. They might have a building that they have purchased. They might have made improvements to that building that they've purchased. And so all of those expenses, again, they're higher dollar expenses, they're assets. They want to do the same thing. And we actually use a little bit of a different term there for that. You might hear this word called depreciation. And so depreciation is, like I said in the laptop example, the same concept applies there. But depreciation is, again, knowing those two things, knowing in the case of that truck, how much should I pay for the truck? Let's say $30,000. What's the useful life of that truck? It's maybe 5 years or 7 years. And then I'm coming up with the depreciation schedule. And so I'm basically taking a certain amount of money each month. And so that's something that we do in my business as bookkeepers or your accountant basically does that in your accounting software, is that we are putting in your monthly depreciation into your accounting software. And so that really helps you to see how much you have depreciated. So as it pertains to your tax situation, that is something that you as a business owner, you really have to decide. You have to decide for everything that's an asset, so everything that you purchase for your business, you have to decide, do I want to just deduct the entire $30,000 of that truck in 1 year? Or do I want to depreciate that asset as a capital expense over the useful life? And so it's something that you have to decide, right when you do that. And so there are, as you can imagine, a lot of different rules around how these capital expenses are depreciated and how they can be deducted from your taxes. And so the point of my video today is not to go through all of those different situations, but I do want to give you a little bit more information from the IRS website and more general topics. So this is a quote from the IRS. It says, "You must capitalize rather than deduct some costs. These costs are part of investing in your business, and these are called capital expenses." And so again, you're not just deducting everything. So for example, if I had $25,000 that I had to put out of my own pocket to start a business, then I'm not able to deduct all of that at once. What I'm able to do is go ahead and capitalize that expense, and then I'm going to amortize or depreciate that amount of money over the longer term. And so again, there's rules around how many years that I can take to do that. And so these are, again, some ideas or some categories of these types of expenses. As I just mentioned, business startup costs are one of those. You can also, if you've made improvements to anything, that would be a capitalized expense. And then obviously like we talked about with the trucks, any kind of large business asset. And so a couple other things just to mention, a couple of these other types of charges, if you will, that can be capitalized would be, number one, like carrying charges. So people that purchase land, they maybe carry the land, they don't make improvements for a while, and then they start to improve the land. That's another type of capital expense. And you could also have, maybe not as applicable to most of you, but any type of research cost. So if you have, let's say, a product and you really want to see if you can improve the product, and so you go about this process of doing research and development. So I think of like a pharmaceutical company and doing their research and development. So that's another example of capitalized costs that a business incurs. And again, those are typically higher dollar costs that they're taking on, and then they can again take that deduction over a period of time as opposed to just taking that lump sum at once. So basically, when you think about these capital expenses, there's really two things that are going on. When you purchase this large asset, like a laptop or like the truck, then you're coming up with those two figures. You know how much you paid for it, and you also know the useful life of that particular asset. So your bookkeeper or your accountant goes in and they basically make adjustments to your books to account for those capital expenses. And then on the other hand, you have all of that. So come tax time, that information that's been put into the accounting software, it's already there. And so it's a very simple thing to have that ready for your accountant, for your tax preparer, to say this is the amount that we have taken in depreciation on these assets. So It's a little bit more work. It's not just as simple as showing, my Asana subscription, but it is a little bit more work, but it's really all to help you see, number one, what are the assets in my business? How are these capital expenses to my business? And then how do I need to account for these expenses over the long term? And so anyway, that is your primer on capital expenses, right? A little bit more involved, threw in some crazy words in there like amortization and depreciation and all of that good stuff, but it's pretty straightforward. If you want to have more information, let me actually pull up the publication on the IRS website that you want to take a look at. If I can pull that up really fast for you guys. It's publication 535, and it's really all about business expenses. And so I will make sure to include the link in the notes below. By the way, subscribe to this channel. I am always out here, and even though it's a new channel, I will be out here on Thursdays giving you guys more information. So we have 2 more sessions to go through on our business expenses area and love the IRS, and then we have a new series coming up very soon. So I look forward to seeing you guys. Please subscribe, leave a comment if there's anything that you would like to learn about bookkeeping, accounting, or tax preparation. So until then, I'll see you next time.